Is it visible? The PowerPoint is visible?
Yes, sir.
Yes,
Okay.
sir.
Thank you. Thank you.
Yes, sir.
So we started with Banking Regulation Act, Section 5B. Important. Section 5B is important. Section 5B talks about definition of banking. Accepting for the purpose of lending or investment. No confusion. Deposits of money from public, money only. Repayable on demand or otherwise. Withdrawable by check, draft, order or otherwise. So you put money. Important aspect of the definition is demand or otherwise, meaning it can be a demand deposit or it can be a term deposit withdrawable by check. So Section 49A of BR Act says only banks are authorized to accept deposit withdrawable by check or demand deposits. To give you an example, the NBFCs, non-banking finance companies, they also do the same business. Like they accept deposit, they give loan to customers. But what is the difference? The difference is NBFCs can accept only time deposit. They cannot accept demand deposits. Important difference. And also, they cannot open either current account or savings bank account. They can open only term deposit. That's why that is the significance of this definition. By a special notification, government has exempted postal, SB, and primary credit societies. They can accept demand deposit. So that's an exception, postal, SB, and primary credit societies. So this is the aspect that we should take into account as far as the Section 5B is concerned. Section 22 of Banking Regulation Act.
There's some voice disturbance is coming, sir.
Voice not hearing. So Section 22 of Banking Regulation Act 1949. That is who gives Reserve Bank of India gives license to banks for opening branches or opening. So Section 7 of the BR Act. So under Section 22 is important because the bank licenses are being given by RBI under Section 22. So it's important. Now, Section 7 of BR Act, it says, if you are a banking company, if you have got license from RBI to start a bank, in your name, there should be bank, banker or banking as part of its name. Earlier, the primary credit societies were allowed to use bank, but now recently RBI has told that it is not permitted. So no other person entry, only a person or an institution which got license from Reserve Bank of India to start a bank can use the banking or banker or banking in their name, and they will have to use banker, banking or banker is a mandatory, is compulsory. So that is as far as the Section 22 is concerned. Now Section 6.1 talk about what are the permitted businesses. For example, the bank cannot undertake trading in commodities. It is prohibited. So what are the activities permitted under banking business? Borrowing or raising money, issuance of LC, travelers checks, indemnity, bank guarantee. So all these are routine things. There is nothing to explain. So I'll just read. You can later on, you can read that. There is nothing more to explain. Buying, selling of foreign exchange, bullion, bill of exchange, deal in debentures, certificates, scripts. So there is nothing much to talk about. These are all routine businesses. Then other than banking business, safe deposit locker, safe custody, collection of securities, agency business for government, manage, sell and realize any property in satisfaction of any claim. That's one point that here we have to take note. So the Banking Regulation Act permits bank to sell and realize property. Under SURFACE, bank can sell and realize property other than for bank's own use. I repeat, other than for bank's own use. Bank cannot retain the property. That means you have taken over one property. You cannot retain with the bank thinking that maybe I will hold it for say 10 years, 7 years. I will get a better price. That is not allowed. Section 9 says maximum period that a bank can hold a property other than for its own use Its own use, yes, no problem. Maximum is 7 years because we are not supposed to trade. We are not supposed to do that as a business. So maximum period bank can hold a property is 7 years. Plus RBI, if it necessary, can extend it by 5 years. Important provision that 7 years is important, 5 years is important. Section 9, if possible, please remember. So that's an important provision as far as we are concerned. Now we are going to talk about constitution of banks. What do we mean by that? We have different kind of banks depending on the constitution. That constitution means essentially under which law that bank is constituted. If we go along and I explain, you will understand. Now, first category we say body corporated constituted under special statute. You have to understand this point because one bank, State Bank of India, is a body corporate constituted under special statute. Canara Bank is a statute. Yes or no? So what do we mean by special corporate or under special statute? Statute means law. So a law passed by the parliament for the special purpose of constituting a bank. So we have an SBI Act. State Bank is constituted under SBI Act, which is a separate law or the act passed by the parliament. So it is a body corporated constituted under special statute. LIC, we have an act. So LIC is a body corporated constituted under special statute. All nationalized banks, we have a special statute. We have one in 1970 and 1980. Whose statute we have? Bank of India. What is that? Banking Companies Acquisition and Undertaking and Acquisition Act. We have two acts. That is, otherwise we normally in normal parlance we say Nationalization Act. We have one 1970, 1980. So Canara Bank, Syndicate Bank, all these are now constituted under that act passed by the parliament. So if there is a separate act passed by the parliament for constituting a bank or for that matter any entity, that is called body corporated constituted under special statute. Now company registered under Companies Act 1956 2013. We had a 1956 Act, but now we have a 2013 Act. That is the latest Act. So all companies, not only bank, any company is constituted under the Companies Act. So all the private banks are in fact companies. You take South Indian Bank, Federal Bank, any bank for that matter, they are all basically they are all companies constituted under Companies Act. That company gets a license under Section 22 from RBI to do banking business. So they get converted as a bank. So all these banks are basically institutions constituted under Companies Act. Then we have cooperative banks. They are constituted under Cooperative Act of the state. And there are two types of cooperative banks. And there are two acts also. That is State Cooperative Act and there's a Central Cooperative Act. So when the cooperative banks are operating in two states, they are coming under Central Cooperative Act. If they are functioning only in one state, they are coming under the purview of State Cooperative Act. This is an important point. That is, if a cooperative bank is operating from two states, say Gujarat and Maharashtra, they will be covered by the Central Cooperative Act. If it is only in one state, it will be covered by State Cooperative Act. So the banking, as per the Constitution, we have three types. Broadly, one is constituted under separate act passed by the parliament, like State Bank of India, or private banks, which are constituted under Companies Act. And the third one is the cooperative. Is my voice clear?
Please respond, friends.
Yes, sir. Yes, sir, clear.
Okay.
Yes.
Yes, sir.
Thank you. Okay. Now, under special status, we have already discussed what are the special status, what are the entities coming? All nationalized bank. So we have Banking Companies Acquisition and Transfer of Undertaking Act 1970 and 80. So banks were taken over by an ordinance in 1969 and subsequently an act was passed in 1971. SBI, we have Regional Rural Banks, RRB Act 1976. So the question is, this is an institution created by a special statute. RRB can be there, State Bank can be there, Nationalized Bank can be there, LIC can be there. So we need to be clear, what do we mean by special statute institutions? Companies Act, all private sector banks. We have two Companies Act, 1956 and 2013. So foreign banks incorporated outside and having a place of business in India. So foreign bank means they are constituted as companies by their own law in outside, and they get license from RBI to open branches. Cooperative, we have already, it's a corporate. Any cooperative bank is nothing but a cooperative society. If it is one state, State Act, I've already told, if it is more than one state, it's going to be covered by Central Act. Now we are moving to RBI Act 1934. Some provisions are important for us, or not all. Now, one basic thing that we need to be clear is, when we talk about RBI Act has nothing much to do with the regulation of banks. That is done by Banking Regulation Act. And only RBI gets all the power. It draws all the power from Banking Regulation Act. RBI Act per se, or on its own, RBI Act doesn't have much to do with the regulation of banks, except two sections that I will be mentioning separately. So 1934, nationalized in 1949, only history. Entire capital held by central government, central office Mumbai. Next point is important. Managed by Central Board of Directors. Okay, one governor, 4 deputy governor. Questions have been asked. How many deputy governors? 4 deputy, 3 deputy. Local boards at Mumbai, Kolkata, Delhi, and Chennai. How many local boards? 4. Important point. They are in Mumbai, Kolkata, Delhi. RBI Act deals with regulation of banks except Section 42 and Section 18. This is what I was telling. Except these two sections, RBI Act doesn't have nothing to do with regulation of banks. Section 42 is cash reserve ratio is maintained under Section 42 of RBI Act. Section 18 is about discounting bills for the banks. So these two are exceptions. These two directly deal with regulation of bank. No, of course, Section 18 is not regulation. Section 18 empowers RBI to discount or rediscount, to be clear, rediscount the bills from the commercial banks. So 42 and 18 are exceptions. One more point, which is not there in PowerPoint. They managed by Central Board of Directors. 12 directors are appointed. Already governor, 4 deputy, 5 director, 5 members, 4 members from regional, 9, and 12 members are appointed as directed by central government. So total 21 directors. So that's not very important, but 21 directors. That is 12 are separate directors, 4 directors, 1 each from the regional, and the 4 plus 1, 5. So 21 members constitute the RBI functions. We have already seen licensing authority. You need to be clear, whatever Section 22 of BR Act, not RBI Act. The power is given to RBI to give license under Section 22 of BR Act. We have already told. Banker to issue currency notes. Section 22 of RBI Act. That is RBI Act. Currency is RBI Act. Because it has nothing to do with the bank. So denomination 2 to 10,000. So that is an important point. RBI, under RBI can act maximum currency of 10,000. We have not issued yet. We have 2,000. Now tomorrow RBI decides we will have 10,000 note. Yes, it can. Monetary control, qualitative and quantitative. How they are bank rate policy, open market operation, cash reserve ratio, SLR, liquidity adjustment facility is nothing but repo, reverse repo, moral suasion. All these powers RBI get under BR Act, except CRR under Section 42 RBI, SLR under BR Act. An important point you can take note, that is CRR is maintained by bank under Section 42 of RBI Act, but SLR is maintained by Section 24 of BR Act. So Section 24 of BR Act. So 42, you just, it's the Ulta 24 of BR Act. So that's very important. So this bank rate policy, open market operation, variable reserve ratios, liquidity adjustment facility, repo, reverse repo, moral suasion. All these we are learning under banking. So I am sure that you would have or you will. In case you want explanation on any of these things, please feel free to ask me in the end, because I don't want to duplicate and waste time. So all these things we discuss under banking, because concepts, what they are. Credit control, we know how the credit control, all these SLR, CRR, open market operation, all these are tools used by RBI to control credit. Banker to government, Section 20 RBI Act, doing banking business for central government. This act, you can remember Section 20. Section 21A of RBI Act, agreement by state government for doing banking transaction. So the RBI also act as bankers for state governments. That is under 21A of RBI Act. Section 17(5) of RBI Act, providing ways and means advanced to government. So what is ways and means to government? You see, when the central government wants money, it asks RBI to issue either treasury bills, which is short-term money market instrument. It can ask dated securities, long-term, 1 year, up to 30 years. But state government are permitted to take loans from RBI on a temporary basis. So they are called ways and means advanced to government. So that is given under Section 17(5) of RBI Act. Bankers, bank and lender of last resort. Bankers bank means all the banks maintain accounts with the bank, and also lender of last resort means whenever there is a liquidity problem for the bank, it goes where it's a last resort. It always goes to RBI. So lender of last. Regulator of foreign exchange. Foreign Exchange Management Act is administered by regulator. As regulator, RBI administers Foreign Exchange Management Act. Appointment and removal of banking boards personnel. So directors or MD, all these can be removed or can be appointed by RBI. Give direction to banks, both for advances as well as general. That we are coming in detail. So let's not discuss here. Inspect and supervise bank. They can send auditors on-site, off-site inspection. Collect, collate, and furnish credit information, because the banks are required. Banks are required to give all the information. Section 18 of RBI Act, we have already told, that is one of the provisions which has direct bearing on the commercial banks. Now we are going to have a look at, so far we have been discussing RBI Act, Banking Regulation Act 1949, enacted to consolidate and amend the law relating banking for regulating banking companies from 1965 cooperative bank. These are all history only. We cannot, there is not much of importance as far as the questions are concerned. Shareholding, dictatorship, voting rights, that is, all these are dealt with. Stipulated shareholding, directorship, all these we are going to discuss separately. Restriction on loans and advances, that is, we cannot give loan against our own share. All this, it will come later. Reserve requirement, SLR, CRR, maintenance of percentage of assets, that is, a certain percentage of assets should be kept in a liquid form. Audit and inspection, all these we are going to have separate slides and separate discussion. Submission of accounts, setting up of depositor education awareness account, fairness one, that is 10 years and above. Inoperative account we will have to, that also we are going to discuss in detail. Management of banks, penalty for violation of provisions, procedure for suspension of winding up of bank business. Section 35AA, central government may RBI to issue direction to initiate a resolution process in respect of a default to IBC 2016. So that is a new provision. 35AA, this insolvency proceedings. The government can give directive to RBI to instruct banks. So that 35AA, that is something to do with the Insolvency and Bankruptcy Act, IBC 216. So licensing of banks, we have already seen, is the Section 20 of BR Act. Who gives? RBI gives the license. What are the conditions to satisfy? Company is in a position to pay its present and future deposit. Any claim, affairs not detrimental to the interest of its present and future depositors, or general. The character of proposed management not prejudicial to the public depositors' interest. Advocate capital and earning prospectus, minimum capital as per section 11 of BR Act, that we are going to discuss. What is the minimum capital requirement? Whether public interest is protected. These are all the RBI satisfies. They are mainly general in nature. I don't find much scope for question in this particular section. Potential scope for opening bank. The granting of license would be generally consistent with monetary stability and any other. This, of course, they are general in nature. Please, it's enough you read it once before you go for the exam. We have nothing much, no concept, nothing is there. So let's not waste time going over all this, because there is nothing much to discuss or nothing much to explain here. So cancellation of license important. There are 1 or 2 points. So RBI can cancel the license. The company ceases to carry business in India. When it can cancel the license, the company at any time fails to comply with any of the conditions imposed section 22(133)(a). That is, section 22 is under which license is given. If it violates the provisions, RBI can cancel the license. Okay, that is not important. But next is a potential question. Who is the appellate authority? That is, RBI has cancelled one license. So that bank can go to central government. Appeal can be preferred again, central government. That's an important point for the question paper. And 30 days from the date of RBI order. That 30 days is important. That is, if a license is cancelled, within 30 days, that bank has to approach central government, because central government is the appellate authority. That point, please take note. Branch licensing is required for administrative officer. If somebody wants to open a regional office, zonal office, new place of business, setting up of ATM, permission granted once in a year and valid for 1 year. That is, 1 yearly it is given. Permission of RBI is required for changing location of existing place of business. So what do we mean by place of business? So suppose you are removing from one building to another, adjacent building. That is not what we mean. So we will understand what is place of business. Permission not needed for within the same city, town or village. So that is not needed. No permission is needed. Same city, town or village. Temporarily for exhibition, mela, conference or like cessation up to 1 month. 1 month you want to have an extension counter like for an exhibition. You want to have a stall. No license is required. You can do the banking business there, but no license. So regional rural banks, the application for permission have to be routed through NABARD. Important point you can take note, because RRBs, if they want to open a branch, they have to send the license through NABARD. One important point. Then what is mean by place of business? Means any office, sub-office, sub-pay office, any other place at which deposits are received, checks, cash or money lent. This is what is the place of business. Now, capital and reserve. Section 11 of BR Act. That is, the banks are required to maintain minimum capital. So that has undergone a change. But here we are talking about when the BR Act came into being. Now it is 500 crores. But here we are talking about the old. But sometimes questions are asked. So if a place of business is more than one state, if a bank is doing business in more than one state, if it is 5 lakh. That more than one place, if it includes Mumbai, Kolkata, then it is 10 lakhs. If place of business in one state only and does not include Mumbai or Kolkata, principal office, it's 1 lakh. Same district, other places mean 10,000 each. Additional 20,000 each for business elsewhere. Same district, other place, it is 10,000. Say go to other district, is 20,000. If place of business in one state only, with one or more office in Mumbai, Calcutta, 5 lakh plus 25,000 each for place of business outside the cities, maximum 10 lakhs. So these are the various combinations. So some potential questions are there. So in Calcutta or in one district, how much? So that please, you need to have an understanding. But this will be shared with you. It will, if you read, you can understand. And even if we go again and again, in one go, it may not be able to register. So you can just go through and be clear about what are the requirements. Because otherwise there is nothing much to explain. These are all factuals only, factual question. What if there is an office in Mumbai and Calcutta, how much? as per the original BR Act. They are not valid even now. Therefore, from the question point of view, they are not as important, but we cannot rule out also, because now mostly capital questions will come on small business, payment bank, and also new generation private banks. So that is the 100, 200, 500. This has to be the focus. But here, just in case you don't want to miss a one or a half mark on this, please focus and understand. After the commencement of the Act, that is, these are all old ones. That is, in India, say maybe 1900, 100 years back, there were banks. Now, as per the Act, minimum paid up capital is 5 lakh. This is what we get, this 5 lakh in even now in scheduled bank. When we ask for what is a scheduled bank, minimum is 5 lakh. So minimum paid up capital 5 lakh. RBI stipulated minimum paid up capital for new private banks 300 crores, that is increased to 500 crore. RBI stipulated 500 crore for private as per new banking license policy. So that is an important information. As per the new licensing policy, minimum capital required for a private bank is 500 crore. So that 500 crore, please take note. It is very easy, because otherwise all this Calcutta, Bombay, all these are, I would prefer, if I am writing the exam, I would ignore that, because there's no point in keeping in mind all this. Maybe if chance of it coming is less, and the amount of effort that we take may not commensurate. Maybe it's a half mark question, 1 mark question. So it all depends on you, the way you look at. But this, I would say, you have to definitely remember 500 crore. And as per Banking Regulation Act, it is 5 lakh. These two we can easily remember. Now, this is an important slide and important point. Subscribed capital not less than 1/2 of its authorized capital. These questions have been asked. So the question will be, the subscribed capital should not be 1/3, 1/2, and be equal to authorized, all these things. So authorized capital means, what is authorized capital? In a memorandum of article and association, it is mentioned, or in the statute, it is mentioned what is going to be the authorized capital. That is the maximum capital a company can have. But no company or any company may not need the full capital. So what they will do, a portion will be offered to the public for subscription. Okay, say if it is 100 crore, 50 crore they will raise later, 50 crores for subscription. Now, even this subscribed 50 crores may not be paid up. You would have seen sometimes the companies accept capital in first call, second call, third call. So paid up means what is already paid up. So subscribed capital need not be equal to paid up capital. So here banking regulation says, if your subscribed capital is 50, at least 25 crores should be your paid up capital. You cannot have 20. So regulation also says, at any point of time, you are raising the capital. We told 50, they want to make it to 100 crores. Then correspondingly, all these clauses should be honored. That is subscription, 50, all this. If increase in the capital takes place, the stipulation should be complied. Bank can raise issue by equity or preference shares. Capital can be raised by equity or preference. But most important is the 2 years. That's a potential question. That is, a bank wants to raise the capital from 50 to 100. So the stipulations that we just discussed, like subscribed capital, paid up capital, 50%, all these should be brought to that level within 2 years of raising the capital. So the 2 years after raising the capital, the 2 years is, so that this is the type of questions that become. So that we need to be clear and we need to take note. Holding of shares and voting rights. No specific ceiling on a person's holding of share in a bank account. One person can hold 25%, 30%, no ceiling. Important point, no ceiling. But as per section 12B, prior permission of RBI is required. Acquisition together with voting right exceed 5% of the paid up capital. So no specific ceiling is there. You can have 30% of the shares you can hold in a bank account. But if you are going to hold 5% exceeds that is above 5%. 5% no. Above 5%, you are going to have 6% of the paid up capital. Then no ceiling, no bar. But you need a clearance from RBI. Why? Because RBI wants to ensure that without RBI knowing, people should not take over the banks. So that is why this provision. If a transfer request is received by the bank, it has to be referred to RBI for its acknowledgement before effecting such transfer. That is, if somebody buys, shares in the market above 5%, that bank has to transfer that shares in the new holder's name. If such a thing happens, before the banking company transfers to the new person, it should be referred to RBI and clearance should be obtained. So be clear about it. No ceiling. If that question comes, yes is the answer. If anybody holds above 5%, then clearance from RBI is required. Both are important points. Restriction as per section 12.2 with regard to voting rights. Restrict to maximum 10% of the voting right of all shareholders. That is, suppose you are holding 30% of the shares. Even then, your voting rights will be restricted to 10%. Important provision. It can be, they can ask the question, it can be 12%, 15%, 20%. But we need to be clear, no matter what your shareholding size is, your voting right will remain at 10%. So please remember, RBI can increase to 20% in respect of private sector banks selectively. RBI can increase this to 20%. 12.3 bars rules other proceeding against registered shareholders by other persons for claiming it. Not very important. Details of shares held by chairman, MD, CEO to be reported to RBI. Simple question can be asked, which is details of shares held by chairman. Anyway, remembering that is not a big deal. This RBI can increase this to 20%. More than that, questions normally is asked about that 10%. That is what you should definitely carry with you. That voting rights, no matter whatever is the shareholding, your voting right is restricted to 10%. That you should not forget. And that is where the most of the time, that is where the question comes. Commission and dividend payment. That is, a bank can pay payment, a dividend, no doubt. But then RBI has laid down some conditions. If that is satisfied, only you can pay the commission and dividend. Commission brokerage discount on issue of shares ceiling 2.5% of the price at which such shares are issued. 2.5 is important. That is, commission brokerage discount on issue of shares. The maximum commission that a bank can pay is 2.5% of price at which such shares are issued. That 2. It's not enough. You remember 2.5. 2.5 we may remember. So 2.5 the face value, 2.1 the paid up value. All these can come. So we have to understand. It is 20. Say if a share of 10 is sold at say 200 rupees, 2.5% of 200 can be paid. Price at which such shares are issued. So that is 2.5%. Section 13 of the RBI Act, ceiling of 2.5% of the price at which such shares are issued. Dividend can be paid only after. Important provisions. At which are the conditions? Sometimes all these 1, 2, 3, 4 they can give, and then they can give. One of them could be the odd man out. One of them is not necessary. So all the points are important. Writing of capital expenditure fully. What is capital expenditure? Initial expenditure, instead of debiting to P&L, we capitalize. This you would have already studied in your accountancy. So if we, instead of debiting all the expenses to P&L, initial expenses, we will carry over maybe to 5 years. So we capitalize the account expenses, and every year from every profit, we reduce. Maybe within 5 years, we will reduce those things. That is called writing of capital expenditure. So you can give dividend only after writing off the capital expenditure fully. Minimum capital adequacy ratio, 9%. That is what our CRAR stipulation in India, that 9%. Net NPA should not exceed 7%. Remember, net NPA, not gross NPA. So we may remember 7%, but vital point we may tend to forget. Net NPA can be paid from current year's profit only. So maybe you have a reserve from last year that cannot be utilized for paying dividends this year. So A, B, C, D, all these points are important because they stipulate the condition under which a bank can pay dividend. If this is not one of the conditions is not satisfied, you cannot pay the dividend as far as a bank is concerned. Writing of bad debts not required provided adequate provision is held. So bad debt could be there, but if provision is held, still you can pay the dividend. Provision for depreciation is provided for. After transferring 20% of the profit to reserve fund, that is section 17 of the BR Act is an important provision. That is every year from the profit, 20%, every bank, 20% of the profit, they should transfer to reserve fund before giving dividend. So that 20%, but recently the RBI has told it is 25% because to strengthen our tier 1 capital. So BR Act provision is 20%, but RBI is told now instead of 20 to strengthen the tier 1 capital, we have to transfer 25%. The banks, bank set up subsidiaries. So we have subsidiaries for some of the banks, for example, Canara Bank, Factoring Division, Factoring Limited, subsidiaries. So we are talking about what are the provisions. So can you have a subsidiary to undertake trading in some goods, rubber or something? No. You can have subsidiary provided to do what is provided for in the BR Act. We have already seen 6.1 permitted business. To carry on business banking exclusively outside India. Say you want to have some of the banks have subsidiaries in Kenya. It's not branches. Bank of India has a subsidiary in Kenya to look after the operation in Kenya. So that's what I mean. To carry on business of banking exclusively outside India. Any other business conducive to spread banking in India. That is, which is related to banking. Those things only they can open the subsidiaries. Very, very important provision. Questions are frequently asked. So please take note. Section 19.2. Section, if you cannot remember, it's okay. But sometimes question itself is as per the section 19.2. Holding of shares by a banking company in any company as pledgee, mortgagee, or absolute owner shall not exceed 30% of the paid up capital of the company or paid up share capital reserve of the banking company. So two things are there. The bank is holding shares of another company, maybe as an owner, or the shares of that company is pledged to the bank, or the shares of the company is mortgage as a mortgagee. We have an interest in the company. Whatever it is, this 30% you have to remember. And not enough you remember 30%. It cannot be more than 30% of the paid up capital and reserve of the bank, or 30% of the company about which we are talking about. Both we have to take into account. It should not cross either this or that, because whichever is minimum. So that should not be taken care. So this is very, very important. Questions have been asked many times on this. Now, board of directors. RBI controls the board of directors of the banks. Now, at least 51% of the total number of directors having special knowledge, section 10A. This 51% has been asked. They will ask at least 60%. They will say at least 50%. That is where we will get confused. So 51% of the directors, they should have special knowledge in what? Either agriculture, accounting, rural economy, SME, banking, cooperation, finance, law, or any other matter beneficial or useful to the banking company. So special knowledge, either you have to be an agricultural background, you have an accounting, maybe you are a chartered accountant, you are a cost accountant, you are an expert in the rural economy, you are an expert in the SME. So you need to have some special knowledge. 51% of the directors. At least 2 of the directors should have special knowledge or practical experience in agriculture and rural economy or corporation or SEP. The 2 directors is important. They are not talking about accounting, all this. They are not talking about here. They are talking about only rural economy, agriculture, corporation or SEP. The directors not to have substantial interest in any firm or a company as employee, manager, which carries trade, commerce or industry. So bankers are not supposed to do trading, commerce or industry. So if the directors have a substantial interest in any other activity, trading activity, then he cannot become a director in a banking company. Substantial interest means what? 10% of the paid up capital or 5 lakhs by individual, spouse, minor child, singly or joint. That means not only director, 10% of the paid up capital of the other company. If the director or his close relatives, they hold, it is a substantial interest. Beneficiary exceeding 10% of the capital of the firm. That is, partnership means about 10% if he holds. So 5% if he is holding, okay. A director period of office, maximum 8 years. Not more than that continuously. So maximum 8 years period is important for a director. That question has been asked. Whole-time chairman, maximum is 5 years. So director 8 years, chairman, managing director 5 years. He can be reappointed. Public sector banks, it is done by Banks Board Bureau of Public, but it does not much. Additional directors, RBI for 3 years can be extended by 3 years further. That means additional directors. Suppose that already a board is constituted, RBI wants to appoint additional directors. So additional directors means term is 3 years. Normal director is 8 years. That distinction you have to bear in mind. 8 years, 3 years. So these are potential questions we should anticipate. The whole time CMD, MD removed, he can be reappointed in the same bank only after 4 years. That 4 years is important. They are telling, suppose RBI has removed somebody as CMD or MD. Can he come back? He can come back in a banking company after 4 years. And suppose he washes away all his sins and then he can come back after 4 years. Board of directors, temporary vacancies arises. Another person can be appointed as whole-time chairman MD for a period not exceeding 4 months with RBI approval till a permanent person being appointed. That is 4 months. That is important. That is not as important as what we discussed in the previous slide, that 8 years, 3 years, 5 years, they are more important. But here they are talking about, suppose a whole-time chairman or MD, there is a temporary vacancy because it will take time for the RBI to decide. For a period not exceeding 4 months, a temporary chairman or temporary MD can be appointed. If the vacancy still continues and bank cannot fill it in immediately as per section 10 BB of BR Act, an eligible person may be appointed immediately for a period of 3 years. That is, after 4 months, they could not complete the process, then another person can be appointed for 3 years. Not very important point. You can all the same, you can just read and try to retain. Corporate governance. What do we mean by corporate governance? We know what is corporate governance. That is, it's a general term applicable to all the companies. Corporate governance means transparency. That means you take into account the interest of all stakeholders, not only the employees, not only the shareholders, the public, the government. Everyone's interest is taken into account. When you do that and then govern a company, then there is corporate governance. Yardstick or standard to measure how the company behaves towards its shareholder, customer, employee, other stakeholders. Stakeholders means it includes customers, employees, public, everything. So if there is a good governance means the attitude of the company, the administration of the company, take into account all the interest of all these people. Since the banks have special position under this as they deploy large public fund. But why the corporate governance is important for the bank? Because they deal with the public money. That point you can take note. That is why corporate governance is important for the bank, because they deal with the public money. Corporate governance is a dynamic concept. Corporate fairness. That means we have to be transparent. We should not cheat customers. Whatever we do, transparency. We advertise everything. We publish everything in our website. Accountability. That means a customer comes and complains. If he incurs a loss, we make good the loss immediately. Accountability towards shareholders, employees, customers, other stakeholders. Other stakeholders means public. The board can oversee the running of the company by its managers. How board members are accountable to shareholders. All these comes under corporate governance. Mostly general in nature, but we need to be clear as to what do we mean by corporate governance. One conceptual question can come, like why corporate governance is important. Otherwise, they are not very specific. It's mainly general. Some initiatives by RBI to improve the corporate governance. RBI has come out with some guidelines. What are they? Fit and proper criteria for directors and CEO. Fit and proper criteria. Earlier we have told 51% of the directors should have some special knowledge. Fit and proper. How a director should be. What are the qualities that he needs to have? That RBI has documented. That is fit and proper criteria. Not more than one member of the family on bank's board. So bank's board, you cannot fill a bank board with all your family members. So that is an important point. Only one member of a family on bank's board. There's a potential question. Not more than one member of an associate, partner, director, employee on bank's board. So if it's a partnership, there can be only one director employee on the bank's board. The stake of large industrial houses to acquire bank shares not to exceed 10% of the paid up capital. Now there is a debate going on whether we should give license to industrial houses for running a bank. Reserve Bank feels, and there is a lot of pressure on the Reserve Bank to do that. But even last 2 days back, one deputy governor has told it is not advisable. So already there is a restriction because the industrialists should not control the banks because they will start misusing the funds. So that is why under corporate governance, they have told industrial houses, they cannot exceed more than 10%, they cannot hold. So they do not have the controlling interest in a bank. They should not be allowed to have control. The board of directors should provide need-based training and ensure responsibility as directors. Directors should be given proper training. They should know how to function as director. All these should be ensured. That 10%, please take note. Fit and proper, please take note. Then one member family, one member of a partnership. All these are potential questions. Regulation of banking business. Important points are there. RBI gives directives to bank under two heads. Under section 21, RBI gives directives for all advance account related matters. So take note. It is under section 21 that RBI gives directives to the bank for matters relating to advance. Deposit note 21. Then under 35A, general instructions. General instructions means including deposit, nomination, including deposit locker. Everything comes under 35A. So section 21 to regulate advances and 35A, general powers to regulate banking companies, deposits included here, not only deposit, general in nature. So section 21 and section 35A, please take note, because that question can come. The RBI gives directive to banks in matters relating to advance under section 21. 35A means general. These directions are applicable only to banks and not to the customers. RBI can supersede the board of banks. That means RBI can say disband a board of. We have seen recently some of the banks' boards have been summarily changed by the RBI. Now, regulation of banking business, acceptance of deposit. They are simple points you may be knowing, but questions definite there could be. Acceptance of deposits, SB, CA, FD, RD. Current account, savings bank, they are the demand deposits. Demand deposits cannot be accepted by NBFCs. I started, is an important point. Minimum and maximum period of FD. That maximum period is, we know, 120 months. Minimum period is 7 days. Minimum period 7 days. Premature closure of fixed deposits. RBI has given directive. That is, now they have been given a lot of freedom. Earlier there was a stipulation that there should be penalty, this many hours interest, there should be minimum. All these have been now neutralized or it has been diluted. Renewal of overdue fixed deposits. How to do it? Reporting of unclaimed deposit. Important, very, very important point. Under section 26, deposited not operated for 10 years. They have to be transferred to RBI. So deposit not operated for 10 years. 10 years important. When it should be transferred to be remitted within 3 months from the period of expiration of 10 years. That means the 10 years, December, it is over. Means before March 31st, it should be transferred to RBI. So 3 months to be reported within 30 days of the end of calendar year. That means every 31st December, the banks have to report to RBI how many accounts are with you which are not operated for 10 years. So here you are bound to commit a mistake. It is as on the last day of the calendar year, 31st December. Most of the things are as on 31st March. But unclaimed deposit position is to be reported as on the 31st December. Please take note. Since it is 31st December, it could be picked up for the question. So 10 years, important 10 years. And it is transferred to a fund called DAF account. That is depositors education. That money is to be utilized for depositors education. So that is why the separate fund is kept. All this money is transferred and RBI keep it in a separate account. So the question comes, suppose after transferring, a demand comes from the customer. They claim back the money. What you will do? You can make a claim on RBI. They will give you back the money. No issues. The RBI will give you back the money. But till that money will be utilized for the education of depositors. Now, nomination, important. These are all things you know already. Section 45 ZA, 45 ZC, 45 ZE. 45 ZA means deposits. 45 ZA means deposits. We know only one person can be a nominee for one account, one deposit account. We cannot have joint nomination. Whether a minor can be a nominee? Yes, minor can be a nominee. But what is the provision? When we nominate a minor, as long as he's a minor, we also have to appoint another person who will act as guardian of that person. So minor is the nominee, but minor cannot take. As long as the minor is the minor, that will be dealt with by the person appointed. Legal heirs have right to claim against nominee. What do we mean by that? The bank pays the money to the nominee. Bank is discharged. Bank's liability is over because nomination rules give you the power. Whether nominee is the legal owner of that money, no. If a legal heir wants to claim the money from the nominee, and if it can be established in a court of law that the money belongs to jointly with somebody as a legal heir or to another person, nominee, it can always be disputed. So we need to be clear is nomination is only for the purpose of bank paying the money. It is not settled that the nominee is going to be the legal owner of that money. That can be subsequently challenged by the legal heirs. That is a separate matter altogether. Section 45 ZC is safe custody account. You can have a nomination, only one person per one safe custody account. Lockers only, we need to remember, single person holding a locker, only one. But in case of a joint locker, we can have joint nomination for locker. Joint, I repeat, joint lockers, we can have more than one nominee. If it is a single customer holding a locker, he can only have one nominee. So that is an exception that you must remember. Banking companies nomination rules 1985 for commercial banks. Cooperative banks nomination rules 90 of cooperative banks. So nomination, cooperative banks are also come under nomination rules of the Act. Rule 2 for deposits, Rule 3 for safe custody, Rule 4 for safe deposit lockers. Not be very important. So Rule 2, Rule 3, Rule 4 along. But anyway, that is not a big deal to remember. Anyway, Rule 2, 3, 4. 2 for deposit, 3 for safe custody, 4 for safe deposit lockers. We have seen that it is under Section 21 BR Act that the RBI gives regulation on loans and advance. What are the directives that normally Reserve Bank gives? Purpose of advance. A bank should ensure the purpose of advance. Margin to be maintained. If there is a stipulation as regards margin, if RBI has given, that is to be maintained. Exposure towards company, firm, association of person, individual. Capital plus reserve. Ceiling on issuance of guarantee to a company, firm, association of person, individuals. Selective credit control on essential commodities. Price stability by curtailing holding. Make bank borrowing more costly. That is, the repo can be increased and the borrowing can be made costly. Selective credit control means to avoid the hoarding of a commodity. Say there is a shortage of sugar. RBI can give a directive saying that you should not give further advance to the traders in sugar, or you have to take more margin, minimum 50% margin. That type of control is called selective credit control. That is normally applied for a particular commodity, especially when the price goes up, there is a possibility of hoarding. So in order to avoid that, the loans or the advance should not be given to traders dealing in such a commodity. So sometimes there have been occasions when RBI has instructed banks not to give money to certain sectors, and that is called selective credit control. So you should know what is meant by selective credit control. By imposing condition as to minimum margin, ceiling on credit, minimum rate of interest, etc. At present only sugar comes within the earlier rice, wheat, everything used to be there, selective credit control. Under Section 20 BR Act, restriction on loans and advances. Important provision. No advance against security of fixed deposit of other banks. No bank can give. So Bank of Baroda, if somebody comes with a fixed deposit receipt of Canara Bank, Bank of Baroda cannot give a loan. Bank of Baroda can give loan against its own fixed deposit. Another bank's fixed deposit, it cannot give loan. Very important. Questions are frequently asked. No loan can be granted to directors. No loan to firms to which directors is interested as partner, manager, employee, or guarantor. Already we have seen what is meant by substantial interest. No loan to a company in which director or the banking hold substantial interest. That substantial interest we have already defined in an earlier slide. Prior permission of RBI required for remission of loans of firms, companies in which a director is interested as director, partner, managing agent, or a loans to any individual whom a director is a partner or a guarantor. That is remission. Suppose you are going for a settlement or you are writing off a debt. That cannot be done for a company where a director or is associated. No loan to company for buyback its own shares. So important point, what is buyback of shares? Recently, Infosys has gone in for buyback. Wipro, what is buyback of shares? There is accumulated profit reserve in a company. So company wants to reduce the number of shareholders. So company will announce that if you surrender your share to us, we will give you a better rate than what is prevailing in the market. So you will be tend to sell the share to the company back. Company normally do it with when it has its own resources and also when it wants to reduce the number of shareholders. Here, what the RBI says is, okay, fine, you can buy back your shares, but under no circumstances, loan should be given to a company to buy back their own shares. No loan against security of bank's own shares. Somebody comes with a Canara Bank share to Canara Bank. Canara Bank cannot give a loan. He goes with Canara Bank shares to Bank of Baroda. Bank of Baroda can give, there is no problem. One's own share, we should not give loan. So both points are important. Banks cannot give loan against its own shares. Banks can give loan against only its own deposits, not other banks. That distinction needs to be borne in mind. No loan to a company for buyback of its own shares. So that is also an important point. Regulation of banking business interest rates for deposits deregulated may permit higher rate for staff, retired staff, senior citizen, deceased constituents, no interest for CA's interest on cooperative banks, etc. Current accounts, it is prohibited. Current account, no interest for current accounts. No bank can give interest on current account if you want. So that is why we have the hybrid deposits now. That is sweep in and sweep out. But current account cannot be given advance. That is a important and deregulation. Now earlier savings bank account was being controlled. Now even savings bank deposit rate is deregulated. Advance means freedom given to banks to decide their own lending rates. Present regulation, deferred DRI advance. Deferred rate of interest means 4%. Poorest of the poor. They can be given loans at 4. There is a scheme called DRI. Weaker section, export finance. All these RBI has regulated. DRI, weaker section, the export finance, RBI has regulated. All other, it is deregulated. Now, different interest rate system. we started with BPLR, benchmark prime lending rate. Then we switched over to base rate. Then we switched over to MCLR. Now it is external benchmark lending rate for MSME and personal segments. Personal loan and MSME. Now we have moved over to external benchmark lending rate. So BPLR base rate and MCLR. All these, one point common is below that rate, nobody can be given advance. So that was one stipulation we had. What is a BPLR? BPLR used to be a benchmark rate. Bank can quote below this rate for as per their choice. Original object was to bring transparency in lending rates, but failed to achieve the aim and difficult to assess the transmission of policy rates to RBI to lending rate of bank and base rate introduced. Now, earlier it was BPLR. BPLR, RBI felt that there is no transparency. RBI was asking how you fix the BPLR. The bank did not have a clear policy or a clear methodology to arrive at a BPLR. So what was happening? RBI will reduce repo rate, expecting the banks to reduce correspondingly, but it was not happening. Transmission, whatever RBI wanted, that transmission was not taken. So RBI felt it is because of the BPLR, because there is no methodology, or it is not related to base rate. The BPLR is not related to policy rates. So RBI told you change your methodology. So base rate to enable better assessment of transmission of monetary policy. All lending rate reference to base rate. Bank cannot quote a rate below its base rate. Exception was DRI loan, bank's own deposit, loan to staff, export finance, loans to weaker section. All other loans are related to base rate. You have to quote 2% above base rate, 3% above. Reviewed once in a year by ALCO, only one rate. Components, average cost of fund, overheads, negative carry CRR means we are keeping CRR. What is negative carry? So we are taking deposit from the depositors and we are keeping that money as CRR. But the RBI is not giving us any interest on that. But even for that 4 rupees, 4%, we will have to give interest to the depositors. So there is a negative carry as far as the CRR is concerned. Tenor premium means how long? Tenor means how long the loan is given. So a premium is added. If it is a 1-year loan, tenor premium is less. 5-year means more because 5-year means risk is more. So tenor premium is added to the base rate, tenor premium. So here, what the difference that took place was sort of transparency was there. Your base rate is 8%. You can explain why that 8%. So RBI felt because cost of fund, it is cost of fund related. So when the repo is reduced, your cost of fund gets reduced. So correspondingly, bank can be asked to reduce their lending rate. So base rate. MCLR to improve the transmission of policy rates, all lending rates exception with reference to MCLR. Some exceptions were otherwise all MCLR. Then bank cannot quote rate below its base rate exception DRI loan against them. Reviewed once in a month by ALCO. 1 to 1 year can be more. 5 maturities minimum. MCLR. They told you should have 5 MCLR depending on the maturity of the loan. Components, marginal cost of funds, overheads, negative carry, tenor premium. Now, here is where the focus should be because this is the latest. So questions normally should get picked up from here because other is history. Though we are continuing with that, we have overcome that and now we have come to external benchmark rate or repo link. What is external rate repo linked to lending rate? It is introduced from 2009. Earlier, we were telling about cost of fund, negative carry of CRR, all these factors used to decide our lending rate. Here, what has happened is our lending rate, we are quoting as 1% above MCLR or 1% above base rate. Here we are telling it is linked to an external rate. Say it is linked to repo. Say repo is 4. So when we quote to a customer that you are going to pay 3% above repo means it's going to be 7. So when repo is reduced, automatically he will pay less. Or when the repo is more, automatically he will pay more. So that becomes more transparent and RBI can transmit the rate much more easily. Or it is related to 90 or 182 days treasury bill rate or other rate fixed by FBIL. So this is how it's an external benchmark. Now, external benchmark is utilized for personal loans and MSME segments. So what is, if the treasury bill rate goes up, automatically the lending rate will go up. If the treasury bill comes down, automatically the lending rate will go down. This is what is the interest rate or the externally linked. So this we need to be. So let us stop for the day here and we will continue next day. If anything you want to ask or if you have any suggestions to make as to whether the speed is more or the clarity is not there, all this you can give the feedback so that those things can be taken into account when we go to the next class. Or anything we have discussed, if you want, you can ask. Otherwise, you can note down and you can also bring it in the next class. Before we start the class, 5 or 10 minutes, we can always use for what we discussed today. You may be going through your notes, and if you have any doubt, that can be discussed tomorrow when we start our class. So if there is nothing, we will wind up for the day. Biju, are you there?
Yeah, I am here, sir. Friends, any doubt you can ask, sir, now.
Hello?
Yeah, friends, any doubts, please ask.
I am not able to hear. There is some disturbance is there. Could you please repeat? I am not able to make out.
No, I asked, sir, any doubt they can ask.
That is
Sir,
okay. Oh, that's what I asked.
Sir, please share the slide, sir.
Slide will be shared, no problem.
Sir, can
If
you
not-
go to the previous slide, sir?
Which one?
Go to 2-3 slides back, sir. Different
Which is
slides.
Which is the one you want? Please tell me.
Go a little bit back, sir. A little bit, sir. Wait, sir. No.
This one?
Sir, previous. No, not sir. Go, friends. Yeah, sir. In this, you said that different interest rate system. You said that you can't land you can't land below an interest rate fixed rate. That's the point you said, no, sir. For,
Except the weaker section, DRI, exporter
Okay.
finance. Then I have told the staff,
yes, sir.
banks,
Yes, right. Agree,
banks own.
Okay, sir. Go to base rate, sir. Go to base
This
rate slide. Base rate slide, sir. BPL, sir. Okay. Bank can quote below rate for this customer. You said that you cannot lend. Now you're saying that bank can quote below this rate for the customer as per the choice.
Bank can quote below this rate for customer as per their choice. Original object was to bring transparency in lending rate, but failed to achieve the aim of difficult to assess. Hence base rate was introduced. BPLR, it was allowed, but base rate onwards, that restriction was brought in. It
Okay,
was a
that's it.
benchmark. BPLR was a benchmark rate. So BPLR, it was allowed. Subsequently, it was not allowed.
Right, sir.
If you like our content, do like, share and subscribe.